Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money games that big companies play. And today we're diving into the Federal Home Loan Bank of San Francisco's latest financial deep dive. You know, the official paperwork they file with the government. Stick around because there are some interesting moves happening with their money and their investments. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more filings and discuss finance strategies. So imagine a big bank that helps other banks stay liquid, kind of like a central banker for other banks. That is the vibe of the Federal Home Loan Bank of San Francisco, or FHLB San Francisco. This isn't your typical bank where you deposit your paycheck. Instead, they offer financial services to banks, credit unions, and other financial institutions. Their latest report, a 10Q filing, gives us a peek into their financial health as of the end of September 2025. Let's zoom into their balance sheet, which tells us what they own and what they owe. At the end of September 2025, they had total assets around $75.8 billion. That is a bit less than at the end of 2024, where they had over $81 billion in assets. What's driving this change? A big chunk of their assets comes from advances, which are basically loans they make to other financial institutions. These advances dropped significantly from over $45 billion at the end of 2024 to around $34 billion by September 2025. This drop is mainly because some of their big borrowers, which are now non-members after acquisitions, are letting their loans mature without renewing them. Think of it like a bank losing some of its biggest customers. On the flip side, their investments like interest-bearing deposits and securities purchased under agreements to resell have actually increased. This suggests they're shifting their strategy a bit, perhaps holding more liquid assets. Their consolidated obligations, which is how they borrow money in big chunks, also decreased, falling from over $72 billion to about $66 billion. This makes sense since they are lending out less money. Now, let's talk about how much money they made. Their net interest income is pretty stable. For the third quarter, it was about $147 million, barely changing from the same period in the previous year. This means the difference between the interest they earned on their loans and investments and the interest they paid on their borrowings remained steady. However, when you look at the longer picture, the first 9 months of 2025 brought in $431 million in net interest income, which is slightly less than the $432 million in the same period of 2024. What is interesting is their other income. In the third quarter of 2025, it was about $19 million down from $30 million a year earlier. This decrease was mainly because they saw smaller gains from their investments in derivatives and other financial instruments that they value based on their current market price. Derivatives can be complex, but think of them as financial contracts whose value is tied to underlying assets. Sometimes these can bring in big gains, sometimes big losses. Their gains here decreased. Let's look at their capital, which is like their own money the bank has, not borrowed money, their total capital. At the end of September 2025 was about $7.1 billion, up slightly from about $7 billion at the end of 2024. This shows they are holding on to more of their own funds. One number that stands out is their regulatory capital ratio. At the end of September 2025, it was 9.5%, which is really healthy and better than the 8.9% at the end of 2024. This suggests they are financially strong and well above the minimum required by regulators. They also have a significant amount of unrestricted retained earnings. Sitting at just under $3.8 billion, retained earnings are profits the company has made but not paid out as dividends. This basically indicates they are profitable and have money left over. Looking at cash flow, it shows where money is coming in and going out. For the first 9 months of 2025, their operating activities actually used up cash, showing a negative $339 million. This sounds bad, but it is often the case for financial institutions as they manage big lending and investment portfolios. Their investing activities, however, provided a lot of cash, about $6.9 billion. This cash comes from things like selling securities and making and receiving advances. Their financing activities, where they borrow money and manage debt, used up a significant amount of cash, over $6.5 billion. This was mainly due to repaying large amounts of consolidated debt. Now, let's break down some of the details from the notes, which explain the numbers more thoroughly. They talk about their investments, specifically their available for sale securities. These are investments they can sell if needed. Within this category, they hold a lot in mortgage-backed securities, or MBS, especially those backed by government-sponsored enterprises like Fannie Mae and Freddie Mac. Around $13.1 billion of these are in GSE's multifamily MBS, and they have about $900 million in private label residential mortgage-backed securities. They also hold about $6.5 billion in US Treasury obligations. They also have a pretty significant amount in federal funds sold, which are very short-term loans to other banks, about $7.3 billion at the end of September 2025. This is way up from about $1.6 billion at the end of 2024, showing a big increase in overnight lending. When we look at their advances, which are their main loans to financial institutions, the average balance for the first 9 months of 2025 was about $43.8 billion. This is down from over $53 billion in the same period of 2024. They explain that this decrease is largely due to advances maturing from members who were acquired by non-member institutions. Since non-members cannot take out new loans from them, this loss of large borrowers is impacting their advance volume. Their consolidated obligations, essentially their own debt that they issue to raise money, also decreased. Bonds outstanding went from over $58 billion to about $48.7 billion. This aligns with them lending out less money. Their net gain loss on derivatives also shows some interesting movement. For the third quarter of 2025, they reported a net gain of $15 million. A nice turn around from a net loss of $49 million in the same quarter of 2024. This is largely due to how they're accounting for these financial contracts, and some of it is related to interest rate movements. Looking at the overall total assets, they went from $81.7 billion at the end of 2024 down to $75.8 billion by September 2025. This decrease is primarily driven by that drop in advances, as we discussed. Their financial strength, measured by their regulatory capital ratio, remains strong at 9.46% at the end of September 2025. Remember, this is their own money relative to their assets, and a higher percentage generally means a more financially stable company. They also track something called duration gap analysis. The duration gap measures how sensitive their assets and liabilities are to interest rate changes. For September 2025, their net duration gap was 0 months. This means the sensitivity of their assets and liabilities to interest rate changes is roughly balanced. This is a good thing for managing interest rate risk. Speaking of risk, they have a whole section on risk management. They are closely watching credit ratings, and Moody's actually downgraded the long-term debt rating for the Federal Home Loan Bank system in May 2025. This sounds concerning, but they state it did not impact their current obligations or have a material effect on their finances. Their mortgage loans held for portfolio, which are loans they keep on their books, are a relatively small part of their business, sitting at about $652 million. They also report on their investment credit exposure, where they hold a lot of US Treasury securities and government-backed mortgage-backed securities. In their management's discussion and analysis, they talk about the overall picture. They mention that net income for the third quarter of 2025 was $110 million, an increase from the previous year, mainly due to lower expenses. They are also highlighting the consistent increase in their capital ratios, reinforcing their financial stability. And on the dividend front, their board declared a quarterly cash dividend at an annualized rate of 8.75%, which is the same sustained rate as before. This shows they are looking to return value to their stakeholders. Now, looking at these results more broadly, FHLB San Francisco appears to be navigating a shifting landscape, especially with some larger members becoming non-members. Their strategy seems to be managing this by holding more liquid investments and maintaining a very strong capital position. However, the continued decline in advances due to non-member status presents a long-term challenge for growth in that core business. The stability in net interest income is good, but the fluctuations in derivative gains and losses show the ongoing presence of market risk, even if they are actively managing it. Their financial strength is undoubtedly a major positive, but the shrinking advance business is a trend to watch closely. Alright, that is our breakdown of FHLB San Francisco's latest financial report. What is your take on these numbers and what they signal for the company's future? Do you think their shift towards more liquid investments is a smart move given the industry changes? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching. See you next time.